Alright, let's play a little financial mind game. Imagine you're looking at your bank account. You see your checking, your savings, maybe even a money market account. You think, yep, that's my money, all accounted for. But what if I told you that's just a sliver of the financial picture? What if there's a whole world of other deposits lurking in the shadows of the monetary system, influencing everything from interest rates to inflation? Now, before you start picturing hidden vaults filled with gold doubloons, let's clarify. We're talking about something called M1. You've probably heard the term tossed around in financial news, especially when economists are discussing the money supply. But what exactly is M1, and what are these mysterious other deposits hiding within it? Think of M1 as the most liquid form of money circulating in an economy. It's the cash you carry, the funds in your checking account you can access instantly, and, yes, those other deposits we're about to dive into. Traditionally, M1 was pretty straightforward. It was primarily currency in circulation and demand deposits, meaning those checking accounts we mentioned. But the financial landscape has changed drastically over the past few decades, and those changes have blurred the lines of what constitutes readily available money. To truly understand other deposits, we need to take a quick detour into the evolution of money itself. Back in the day, money was pretty simple. You had physical cash, and that was it. But as technology advanced and financial instruments became more sophisticated, the way we hold and transfer money changed dramatically. Think about the rise of online banking, mobile payment apps, and the explosion of digital transactions. These innovations have created a plethora of new ways to access and utilize funds, often blurring the lines between traditional checking accounts and other forms of liquid assets. So, what are these other deposits that are now included in M1? The answer lies in the shifting definition of what constitutes readily accessible money. Simply put, these other deposits are accounts that, while not technically demand deposits, function very similarly in terms of liquidity and accessibility. One key component of these other deposits is often linked to negotiable order of withdrawal, NOW accounts. NOW accounts, for those unfamiliar, are interest-bearing checking accounts that allow for unlimited check writing and withdrawals. While they technically fall outside the traditional definition of demand deposits, their functionality is virtually identical. They offer the same level of liquidity and accessibility, allowing individuals and businesses to easily access their funds for daily transactions. Another significant category within other deposits includes credit union shared draft accounts. Similar to NOW accounts, shared draft accounts offered by credit unions provide checking-like functionality with interest-bearing features. These accounts, again, blur the lines between traditional checking and other liquid assets, making them an integral part of the M1 money supply. But it doesn't stop there. The rise of money market deposit accounts, MMDAs, has also contributed to the expansion of M1. MMDAs, while technically savings accounts, offer limited check writing privileges and often come with debit cards, making them highly liquid and accessible. While they might have restrictions on the number of transactions, they still function as readily available funds for many individuals and businesses. Now, you might be wondering, why does this matter? Why are economists so concerned with these other deposits within M1? The answer lies in the crucial role that the money supply plays in the overall health of the economy. M1, as the most liquid form of money, directly impacts spending, investment, and ultimately, inflation. When the money supply increases, it generally leads to increased spending and investment. This can stimulate economic growth and create jobs. However, if the money supply grows too quickly, it can lead to inflation, as the increased demand for goods and services outpaces the available supply. Conversely, a decrease in the money supply can lead to decreased spending and investment, which can slow down economic growth and potentially lead to deflation. By tracking M1 and its components, including other deposits, economists can gain valuable insights into the overall health of the economy and make informed decisions about monetary policy. The inclusion of other deposits in M1 reflects the evolving nature of money and the increasing complexity of the financial system. As technology continues to advance and new financial instruments emerge, the definition of money will likely continue to evolve. This means that economists and policymakers will need to remain vigilant in monitoring the money supply and adapting their strategies accordingly. Let's break down the impact even further. When the Federal Reserve, or any central bank, is trying to manage the economy, they look at M1 as a key indicator. If other deposits are growing rapidly, it suggests that there's a lot of readily available money in the economy. This can signal potential inflationary pressures, prompting the central bank to take action, such as raising interest rates. On the flip side, if other deposits are stagnant or declining, it could indicate a slowdown in economic activity. This might prompt the central bank to lower interest rates or implement other measures to stimulate growth. The key takeaway here is that other deposits within M1 are not just a technicality. They represent a significant portion of the readily available money in the economy and play a crucial role in shaping economic conditions. By understanding these components of M1, we can gain a deeper appreciation for the complexities of the financial system and the forces that drive economic activity. It is also important to consider the impact of technological advancements on the definition of M1. The rise of digital payment platforms and cryptocurrencies has blurred the lines even further, making it increasingly difficult to track and measure the money supply. As these new forms of money become more prevalent, economists and policymakers will need to adapt their frameworks and methodologies to accurately capture their impact on the economy. For example, consider the rise of mobile payment apps like Venmo and Cash App. These platforms allow for instant transfers of funds between individuals, effectively creating a parallel payment system that operates outside the traditional banking system. While these platforms may not be fully captured in current measures of M1, they still represent a significant portion of the readily available money in the economy. Similarly, the emergence of cryptocurrencies like Bitcoin and Ethereum has introduced a new layer of complexity to the money supply. While these digital currencies are not yet widely used for everyday transactions, they are increasingly being adopted as investment assets and stores of value. As their adoption grows, they will likely have a greater impact on the overall money supply and the economy. So, the next time you hear about M1 in the news, remember that it's not just about cash and checking accounts. It's about a broader spectrum of readily available money, including those other deposits that play a crucial role in shaping the economy. And remember that the definition of money is constantly evolving, influenced by technology and innovation. With that said, thanks for watching, and until next time.